You've been grinding your short-term rental, collecting those Airbnb checks, and now you're eyeing a big multifamily building. But here's the question, keeping investors up at night. Can you actually do a 1031 exchange to get there without handing the IRS a massive check? The answer is yes, and it's one of the most powerful yet underused moves in real estate investing. But there are landmines everywhere if you don't know the rules. We're talking about a tax deferral strategy so potent that some investors have rolled modest vacation rentals into small apartment empires, completely tax deferred, while others have blown the whole thing on a technicality. So let's back up and understand what a 1031 exchange actually is, because the IRS didn't exactly write this one in plain English. Named after Section 1031 of the Internal Revenue Code, it allows you to sell an investment property and reinvest the proceeds into a like-kind property, deferring all capital gains taxes that would otherwise hit you like a freight train at closing. Now, here's where people get tripped up. Like-kind sounds like it means you have to swap a cabin for a cabin or an apartment for an apartment, but that's actually a common misconception. In the world of real estate, like-kind is interpreted incredibly broadly by the IRS, meaning most real property held for investment or business use qualifies, regardless of property type. So yes, a short-term rental, your beach house, your mountain cabin, your trendy downtown condo on Airbnb can absolutely be exchanged into a multifamily property as long as both properties meet the qualifying criteria. The critical phrase there is held for investment or productive use in trade or business. And that's where your short-term rental has to prove itself worthy. Here's the uncomfortable truth though. The IRS scrutinizes short-term rentals harder than traditional rentals because the line between investment property and personal vacation home gets blurry fast. If you've been sleeping in that lake house every summer for 2 weeks and calling it a rental the rest of the year, the IRS might have some thoughts about that, and those thoughts come with penalties. The IRS actually issued Revenue Procedure 2008-16, which created a safe harbor rule that gives short-term rental owners a roadmap to qualify. Under that guidance, you need to have owned the property for at least 24 months before the exchange, rented it out at fair market value for at least 14 days in each of the two 12-month periods, and kept your personal use to no more than 14 days, or 10% of the days it was rented, whichever is greater. If your short-term rental clears that bar, you are in the game. And now the clock starts ticking the moment you close on the sale. You have exactly 45 days to identify your replacement multifamily property and 180 days total to close on it, and the IRS does not grade on a curve. Historically, investors who've used this strategy correctly have compounded their wealth at a staggering rate, essentially using the government's deferred tax money as an interest-free loan to buy bigger and bigger assets. Think about it. If you owe $75,000 in capital gains on the sale of a short-term rental and you defer that, you're essentially investing with $75,000 extra dollars that you haven't actually earned yet. The psychological trap here is overconfidence. People hear like-kind is broad and they get sloppy with the details, skipping the documentation, mishandling the qualified intermediary requirement, or accidentally touching the exchange funds themselves. The moment you personally receive those sale proceeds, even for one day, the entire exchange is disqualified and the full tax bill becomes due immediately. A qualified intermediary, sometimes called an accommodator, is a non-negotiable part of this process. A third party who holds your funds between the sale and the purchase, so you never take constructive receipt of the money. Choosing the wrong one, or a financially unstable one, is a real risk that has burned investors before. So vet them like you'd vet a business partner. The practical lesson from every investor who's done this successfully is to start planning the exchange before you list your short-term rental for sale, not after, because the timeline is brutal and surprises will happen. Work with a CPA who specializes in real estate, a qualified intermediary you trust, and a real estate attorney, because trying to DIY a 1031 to save a few thousand in fees while deferring hundreds of thousands in taxes is the definition of penny wise and pound foolish. The beautiful irony of this whole strategy is that the IRS essentially built a wealth-building escalator into the tax code, and most small investors don't even know it's there. You can keep rolling gains forward from property to property for decades. And if you hold until death, your heirs receive a stepped up basis, meaning those deferred gains could potentially disappear entirely. The discipline isn't in knowing the strategy exists, it's in executing it cleanly, documenting everything obsessively, and not letting greed or impatience blow the timeline. Whether you end up in a 4-unit multifamily or a 20-unit apartment complex, the process, the patience, and the proper positioning matter infinitely more than the conviction you feel about any single deal. Check out the links in the description below whether you're looking to get started in real estate investing, need contracting work done on your properties, or want to connect with lenders who understand investment strategies like this one. We've got the resources to help you take that next step.